It's May the 5th, 2020. It's about 5:30 on the Sunday. Today we are going to try and answer the question, which has been asked quite frequently recently by both people calling in or people coming into the webinars. What can I do if my investments are losing money presently? Okay. Before that, about a month or so ago, I have a YouTube video which is titled almost the same. What should investors do? Please do have a look at that video itself, because in the video itself, basically, I highlighted that the course of action that you actually should take as an investor basically depends on what type of investor you are. If you are a short-term investor, meaning to say that you're the type of investor looking to make money over the short term by going in and out of the markets, then basically your strategy is a market timing strategy. And thus, maybe this question doesn't even apply to you because you're trying to go in and out, in and out, in and out. If you are a long-term investor, like more or less where we try and help to advise our clients on, and they are long-term investors, and then it really depends on whether you are a passive or active type of investor, whether your portfolio is passively allowed to move or actively managed. Because if you're a passive investor, then basically you stand by the side and allow your portfolio to just run its course. Because over the long run, a passive investor believes that an active manager can't outperform. The market in itself will take point B to be higher than where an investor starts off from point A. Okay, but if you are active, or you hold an active portfolio, very much like how we do things, then basically you look to de-risk at cycle tops and re-risk again at the cycle bottoms, and try to make that journey from point A to point B easier to undertake by lowering down the volatility of the portfolio. So basically that's in a nutshell how an investor should approach it. So just to give you an example, for our in-house portfolios, we have portfolios for people who want to be a bit more passive. Okay, and we also have portfolios for people who want to be a little bit more active, or allow for their portfolios to be managed a bit more actively. So those who are in an active portfolio, we have de-risked their portfolios in order to represent what is happening in the markets today, i.e. we believe there's risk, and so therefore that portfolio is really a representation of what it ought to be in the current market. Okay, so that's really very much about people, investors who have actually decided what type of investor they want to be. However, there are investors who today suffer losses and are a little bit shaken, and they feel that they need to do something, because maybe it's not the case whereby they don't need to act. As I explained earlier, most cases you really don't have to act, because either you're in a passive portfolio, or even if you're in an active one, the person managing that portfolio has already done things for you. But if you felt that the March decline was something that affected you psychologically, that probably shows that something is amiss, and you probably need to do something. This tends to occur when there's a mismatch between what we call investor risk and in portfolio risk. When you are a conservative, a moderately conservative investor, but throughout the years, because performance was very good on the equity side, your portfolio actually swung over to being 100% equities, despite the fact that you're a conservative investor. So there's a mismatch. So therefore, when the equity portfolio, 100% equity portfolio, falls drastically, as a conservative investor, you feel stressed about it emotionally. So that's where the question typically comes from those investors who may have a mismatch in their actual portfolio vis-a-vis their risk profile. Of course, getting out is an option. I mean, it's easy to say that I'll just get out and try and wait. for a better time to go back in again. But that brings in the element of market timing. Again, we believe that market timing basically is more for short-term investors, not so much for long-term investors. We tend to take the route of trying to manage that risk rather than coming out totally with respect to volatility. So for example, someone who comes to us to say that my portfolio is down by 20%, I'm very worried that if the market declines further, then my losses will grow. What do I do? Okay, so this episode is basically to try and answer that for this group of investors who may find themselves stuck in the markets with a loss and with a sense that they cannot handle the volatility because of a mismatch in the portfolio and their risk profile. And this is important because this is a very interesting chart. It's taken from a Twitter site called Macro Charts. It actually shows basically the most volatile years in the history of the S&P. There are about 15 years here, and they are defined as volatile because they consist of many days that are in excess of 1% swings, either to the upside or to the downside. Okay, so that's considered to be volatility. So what you can see is for this current cycle, 2020, so far we have seen probably about 40 over days that have swung more than 1%, making it the sixth most volatile year compared to the past 15 other years. What is interesting is that for all these years which were very volatile, you will see that the volatility started off at the beginning of the year and lasted throughout the whole year. Some of them for about 103 days and some of them for about 181 days. Okay, so what that basically means is that if we consider this to be true and to reoccur, this current volatility that we are seeing for 2020 should continue for the rest of the year, or at least for the next 120 working days in the future. And so if you're a conservative investor, moderately conservative investor, even a moderate investor, and you're parked in a 100% equity portfolio, you're going to have to sit through this volatility in the coming months, which again might not be something that you want to do. Okay. So what are the strategies that can be adopted to actually try and mitigate some of this risk? Okay, we'll go through them one by one. The first one, I call it the damage control approach. It's very suitable for people who are really conservative. They've seen the decline in March, and although markets have recovered, now they're worried about their portfolios, whether a further decline would then bring their portfolios down again in the next couple of weeks and months. Okay, just looking at the performance table here, what I've done is I've actually divided into three different types of portfolio. One is 100% equity, another one is a combination of equity and bonds, and another one is 100% bonds. Just like to highlight to you that the bond index that I've used is a so-called global bond index. When you invest using this strategy, you really need to make sure that the segment of the bond market that you go in is a relatively safe one, because even at this point we have segments of the bond markets which are a bit more suspectful, like the high yields, even some emerging market segment of the emerging market bonds and so on. Okay, so you need to make sure that the bond segment that you are allocating in is actually the relatively safer ones. Okay, but what this strategy does is that it moves away from, it takes a portion of your equity allocation and moves it over to the bond side. Okay, and as you can see, as you move more and more, and this is again trying to just show the extreme, if you move 100% into bonds compared to 50% into bonds, what you do is you actually lower the volatility and you actually lower the losses. So basically in the January to March decline, had you been sitting in a 100% bond portfolio, you would only have lost 4.3%. Had you been sitting in a 100% equity portfolio, you have lost 27% and 15% in the middle if it's a 50-50 portfolio. To date, that means January 1st to April 29, had you been in a 100% bond portfolio, your losses would have been much less, and therefore if you had been 100% equities, you would have still lost money, about 9%. So you can see from here, even if the market goes down and you've parked yourself in a 100% bond portfolio or even a 50-50 bond equity portfolio, it would be able to guard against what we call volatility, especially to the downside. Okay, so you wouldn't be losing a lot vis-a-vis equities if the equity market turn and you are majority in bonds or even 100% in bonds. So it's something you would rush into or put your money into or change your portfolio into if today you are worried about a decline. So this is strategy number one. So I call it damage control. Strategy number two, I call it the as soon as possible approach. Why do I say so? Well, this is for investors who have lost money and they say, I just want to make back those losses as soon as possible, as fast as possible. I've chosen two funds, and these are funds which are available to retail investors. I've not named the funds, but these are just characteristics of the fund. One of them is a gold fund, another one of them is called a volatility fund. Same thing, I've done the back test for January 1st to March 23rd, the first decline here. As you can see, the portfolio which has what we call totally alternative investments, i.e. this gold fund and volatility fund, it actually went up by about 6%. Okay, even though the gold fund went down, the volatility fund went up together. When you mix them together, actually it still comes up with a slight positive 6.4. And here, if you do a 50% equity, 25% gold, 25% volatility fund, you end up with a minus 10 versus the full equity, which is 27. And if you do a year to date, then you get this kind of figure. So you can see that the alternatives itself actually provide the potential to actually make back whatever you've lost. So for example, if you've lost 20%, this move into alternatives, 100% alternatives actually made back for you 23% and so on. Okay, but I do have to really warn people who think that this is the easy way out, because alternatives themselves are quite volatile. If you look at this particular chart where I put the volatility fund against the MSCI World year to date, sorry, not year to date, just I think for the past one or 2 years, you see that it actually is asymmetric to the MSCI World, meaning to say that when MSCI World, which is in red, goes up, this fund goes down. When MSCI World goes down, this fund goes up. MSCI World goes up, this fund goes down. So it's a bit like a mirror image. So you can understand that there's volatility, because when the stock market rises, it drops. When the stock market drops, it rises. Okay, so there's risk there. Similarly, gold itself, as you can see, the golden line here, it actually flip flops quite drastically up and down, up and down, up and down, and that's risk. Okay, so this strategy itself comes with risk, i.e. high returns, high risk, high returns. So it's not for everyone also to just jump in to adopt this strategy. You really have to be able to take the risk. Strategy number three, which I call it the systematic approach. This approach to me provides a more systematic way of regaining the losses that you've made. What it entails is, let's say for example, today you start off with a 100% equity portfolio with minus 20% losses. What you do is you move away from equities. You create a portfolio now which consists of 50% bonds and 50% alternative investment. Okay, and after 2 years, 3 years, you've made back your losses, then you can actually move back into the equity markets, and at that point in time you would have zero losses because you've recouped your capital. Okay, put this into context. We do have, for example, an alternative fund, and this is real numbers, which is only meant for AI, accredited investor. Again, I'm not naming the fund. If you need to find out more, you need to talk to your financial advisor, but I'm just taking this as an example. This alternative fund mixed together with this particular bond fund, which is also real numbers here, what we get is at a 50-50 mix. This is the weighted returns for a portfolio made up of 50% alternative AI fund A and bond fund B. Okay, this 2-year rolling return tells you basically, for example, 17.9% is for someone who has held this for the past 2 years, 11.3 plus 6.7. 22.1 is for the past 2 years, 6.7, 15.5. So it just basically tells you if you have held this portfolio for the past 2 years, this is the amount that you would have made in return. And you can see from this column here, more or less, historically, again, I have to warn you that past performance is not an indication of future performance, but historically the numbers tell us that if you hold this particular portfolio based on the back testing, you would make back that 20% loss in 2 years. Okay, basically you make that 20% loss in 2 years, and then you can then re-enter the equity markets again, now back to square one, i.e. you with your capital intact. Okay, so it does hinge on a few things. One of them is basically these numbers here will have to remain consistent, although historically they have. There's, again, we cannot guarantee that in the future they also will continue to produce these kind of numbers. Okay, this is, I consider, to be more predictable, meaning to say that because we're basing it on the historical trends, we can actually derive from the historical returns a kind of like estimate when you would actually break even and recover your losses. Give you an example. If this portfolio itself historically 2 years it provides 20% return, then we know that the 20% return that you've lost, or 20% that you've lost, will be returned in 2 years time. If we create a portfolio which actually every year gives 5%, okay, historically, then we can more or less make an assumption that over the next 4 years, 5 times 4, 20, that you would then reach the break-even point, recover all your 20% losses in the next 4 years. Yeah, so the predictability comes from that perspective, but based on certain assumption. Okay. Strategy number 4. This is what I call the market recovery approach. This involves today, for example, if you have 20% loss sitting in a total equity portfolio, this involves switching out everything into what we call a money market fund, which is very safe, okay, and then gradually taking portions of it over a period of, say, 18 months, and then reinvesting that back into the markets. Okay, so this is called dollar cost averaging. So what we're looking to do is, if markets really fell, you'll be actually buying into markets at a lower and lower price here, and what you want to actually secure is what we call a dollar cost averaging average buy-in price, because after all these installments are put in and you average out, this is your price, the red line, the red solid line here. Okay, what will happen is you take the first phase, which is the first maybe 2 years, to accumulate and to do this dollar cost averaging. After that, you secure your buy-in price, then you allow a consolidation phase to take place where the markets actually start to recover, and you recoup or basically reap your gains thereafter, after the market goes past what we call your average buy-in price. Okay, this is basically a strategy for those who want to remain engaged also with the equity markets. What do I mean by this? If you remember the previous strategy where you move out from equities into bonds, into what we call alternative investments, if the equity markets go up, you are totally out from the equity markets because there's no element of equities in your portfolio. Here, basically, you could still have elements of equities in your portfolio, meaning to say that if the equity markets suddenly turn up, what you could theoretically do is, if you're convinced that the upturn in the equity markets is permanent, you could actually bring forward all these installments or dollar cost averaging or average installments that you've not undertaken, bring it and now do it in the front end. Okay, because that it has some flexibility. So meaning to say that if the equity markets swing up, you're already in the equity markets, but maybe 3 or 4 installments, you can actually just now bring the remaining 14 installments all the way up to the front end here. You need not have to undergo and wait for the next 14 months because markets are moving higher. So there's some flexibility there with regards to this particular strategy when it comes to being engaged with the equity markets. We have recently launched what we call market recovery portfolio, which is based on this, meaning to say that over the next 18 months, you would actually be dividing whatever you want to invest in and going into the markets over an 18-month period. Okay, hoping that when the market falls, you'll be able to buy in and get a nice average price. If the market rises, it's okay. Maybe you've gone in 4 already. You've got another 14 installments. We can always bring the installments back up to the front end. Okay, so there's some flexibility there. The market recovery portfolio, just for your information, is not new, meaning to say we've done it once before in 08. In '08, our clients actually started to go in around September '08, finish their installments, and that was a shorter installment, about 10 months. Finished their installments at the end of July 2009, and we managed to actually just what we call DCA through the bottom. Got a nice average, and this portfolio actually started to make money quite soon after the markets bottom out in March '09. Okay, so that's more or less what we want to aim for this time around, although this time around slightly longer, about 18 months, not 10 months. Okay, let's do a quick summary of the strategies. Basically, if you are adopting strategy 1, basically it's a very conservative approach. It's very suitable for investors who say, look, I'm making a loss. I need some time to think, but I'm quite worried that the markets may fall now. And so what this investor does is move the majority of his or her portfolio into bonds in order to get some breathing space temporarily until he or she decides what to do. Okay, so it will actually stop the bleeding, but it's not designed to recoup the losses. Okay, so you must also remember to pick what we call the correct segment of the bond markets. You don't want to go out from equities and go into what we call, let's say, for example, high yield, which is also quite risky within the bond segment. Okay, and it also depends on a negative correlation. Stock markets go down, bond markets are by right supposed to go up, or at least hold water in a sense, rather than go down together with the equity markets. Okay, because then again, once the correlation is positive, then it doesn't really work because both go down at the same time. The second strategy, the as soon as possible strategy, is really an aggressive strategy. It's one for an investor who is of a slightly higher risk, who says that, look, I want to make back my money as soon as possible. I'm willing to go in high volatility, high risk, high return, and he goes in. Okay, so it's really akin to shorting the market, although it's not officially a shorting. It's just that the investments that you buy, like gold and volatility, they tend to have a negative correlation with the market. Okay, but it entails what we call a high risk. It actually could go against you, meaning to say that you short the market, you go and buy gold, you go and buy volatility, thinking that the markets are going to go down, but instead the market goes up and you start to lose money. So you lose money on both ends. So it's again slightly high risk kind of strategy, but just one which is again open to those who may want to try and adopt this. The more preferred one is the systematic approach. Okay, where again you bring your money out from equities, look for an alternative from equities, either a combination of bonds or alternative investments, which historically has provided a certain returns, 5%, 4%, 10%, whatever the case is. Judging based on that returns, make an estimate. Okay, if I invest in this portfolio, it's going to take me 2 years to recoup my losses, 3 years to recoup my losses, 4 years. So at least there's some visibility based on historical performance. Okay, but again, it really depends on that historical. You have to have confidence that historical performance will continue into the future. Okay, and you're not in equity markets because you've come out. So basically, if equity markets turn up, makes 20%, you're not going to make that 20% because you're out from equity markets. Okay. If that's an issue for you, then the market recovery one would be the best. Meaning to say that you're worried at the same time markets will go down, but you have this lingering feeling that markets may go up. Okay, so maybe the market recovery is a better option, because what happens is the market recovery portfolio does it in installments, as I explained. Basically, it still keeps you engaged with the equity markets, because if the equity markets suddenly turn up, you can bring forward those undispensed installments all the way to the front end. Okay, you don't have to stick rigidly to what we call the dollar cost averaging. So there's flexibility there to take advantage of a rebound, unexpected rebound in the equity markets. Okay. There are some cons of this strategy, i.e. sometimes I mentioned it takes 2 years to recover, another 1 year to consolidate, and so on and so forth. These are not guaranteed timings. If the market really goes down and settles and consolidates for 4, 5, 6 years, then again you have to wait it out. Okay, because you have to wait until the market moves above your average before you can actually make money. Okay, so really there's some risk there also. Okay, so some of you may have this question. So what if I go in and I try and mitigate the risk, and instead the equity markets continue to rise? I've mentioned it already, meaning to say that some strategies where there are elements of equities within it, they're not too bad, because if the equity markets really go up, you have some exposure to the equity markets. Okay, then you can actually jump back on again and take all those, for example, in the market recovery portfolio, the unused installments, bring it forward and use it immediately into equities. Okay, but I think you need to really have the correct mindset. And what I mean by that is this. You see, when you're worried about losing the opportunity of making money, you're really worried about the potential gains that you may not make. It's an opportunity cost. Okay, so you're worried about that. That's fine. I think it's pretty normal for investors to worry about that. But do remember that that is just an opportunity cost. It's not a real cost to you. It's an opportunity cost. However, if you don't take action, and you remain in the market because you're worried about not making money, okay, and the market comes down, your capital will lose money, and that's a real loss. Okay, so what I'm trying to say is, one is a potential opportunity loss because you didn't make the money when the market's rally. Another one is a real loss because you were in as the market fell. So again, it's really for you to consider what to do. But my advice would be, if you are someone of a low risk, a moderate risk, and you feel uncomfortable after sitting through much, you may want to weigh how to actually reconstruct your portfolio and adopt maybe one of the strategies which I mentioned in order to take some of the volatility off your portfolio. Okay, so basically, if you really have further questions on these various types of portfolio, do contact us. Do contact your financial advisor in Financial Alliance or even FA Advisory in Malaysia. Please subscribe to our YouTube if you like to be informed of any further updates in the future. Otherwise, thank you very much and stay safe.